Will Trump force Powell's hand? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Ben Miller, the co-founder and CEO of Fundrise. Hi, Ben. It's great to have you on again.
Yeah, thanks for having me.
So, rocky start to the week. Again, market volatility continues. We have U.S. stocks dropping sharply, the dollar hitting a 3-year low against a basket of currencies, Treasury selling off with the 10-year yield back at 4.4%. What do you make of this market action?
I mean, is the market still absorbing this dramatic change to the way the country is going to work? And so, in the short run, the volatility could be drive it up, could drive it down. But in the medium term, the market's taking its time, but it's processing a dramatic change to our trade policy and also to our the U.S. economy, the way it's going to function in the future.
Yeah. I think everyone's having a kind of a hard time wrapping their head around these changes because we have so many things happening at once. One of the things, or one of the concerns or areas of concern that I am hearing increasingly over the last week is that, as shocking as the sort of tariffs were, which really started this whole move, the Liberation Day, and a lot of the concern, I think, and negativity we're seeing, as shocking as that is, it seems like this is morphing away from just being about tariffs and a tariff war to much more concern about the capital markets and functioning of capital markets in the US. And the fact that we have all stocks, bonds, and the dollar all falling at once. I have people talking to me about, this looks like an emerging market country, and this is not a trade war, this is a capital war, and it's not going well so far. What are you most focused on? Are you concerned? Are you focused on tariffs? Are you worried about treasuries? Kind of where's your head in terms of those concerns?
Well, I'm not a day-to-day trader, and so a lot of times I look at what's happening in the market. It doesn't have a big impact on my point of view because it changes so much, and I don't think usually there's signal in the noise. So in the short run, yeah, the policy, the intended policy of the Trump administration is to weaken the dollar. So one of the things I think that people are unsure about is there a plan? And I think there is a plan. They've published the plan in the past. So the plan was written by Stephen Moran, November 2024. You can go find it. It's called A User's Guide to Restructuring the Global Trade. And in it, they outline all the things they intend to do. And we're about halfway through that plan. So as surprising as it has been for most people, including me, I think that I didn't believe they would follow through on that plan. They really have. And so far hasn't gone exactly according to plan, but I think they're not done yet. And you really have to look through a lot of this volatility, I think, because in the short run, it just doesn't mean anything.
That's interesting. So do you think they're going to be able to execute the plan and succeed? Like, how do you see this playing out?
Yeah, so I mean, I don't know, right? I can tell you what their stated plan was. I can tell you, I mean, a little bit about some obvious like flaws with it. But I mean, whether or not they succeed, right? That the whole market doesn't know. That's why the market's so volatile. So, but the important things is to recognize that the tariffs, the dramatic tariffs, and the dramatic tariffs had two purposes, and sometimes those purposes are at cross purposes. One was to bring back U.S. manufacturing, which is about jobs, about supply chain stability. It's about, I think, a little bit of like a sense of autonomy, American autonomy. On the other hand, they have a geopolitical aim about ring fencing China. I think those two aims are often in conflict. I think it's very hard to have your cake and eat it too. And so it's really unclear to me which of those two aims really are trying to get at any point in time. And I think that's one of the reasons you've seen some confusion along the way, because I think it's very hard to have a policy that has two different aims that are not necessarily consistent.
Yeah. So have you changed anything about your approach, given the fact that they are given the Trump policies, has it changed your, because you have sort of a very interesting holdings, or that you're in the hard asset universe by you real estate, and yet you also do venture with technology and AI. So you're across all of those markets. Has anything changed? How are you responding to the Trump policies, or this, at least the stated attempts at executing on this?
Yeah, so much success is just being lucky. And so, the Biden policies were not that good for real estate. I mean, I don't know how much you're in the real estate business, but the state of the economy before Trump and the state of the economy now, it's so helpful to look at the contrasts, and you can see then sort of the policy aims, and then you can play that out a little bit. So
Mm,
under the Biden policy, there had been a lot of government stimulus, a lot of government spending that had been flowing through to the consumer, and the consumer was seeing a lot of wage growth and then driving a lot of consumer spending. So you had this virtuous cycle that was good for everybody but real estate, because it was driving wages, it was driving inflation, it was driving consumer spending, it was driving the stock market. Um, the challenge was it was keeping interest rates higher for longer, and at one point late last year, it looked like interest rates may never come down. Maybe they would stay at 4.3%, where the Fed had kept overnight rates. And that was a problem, obviously, for anybody who was levered. And that's not just real estate; it's also the federal government. The federal government has I think like $9 trillion rolling over this year, and as their long dated treasuries roll over, they roll over to a much higher interest rate, and that was driving increased deficits. So you see, I think we're headed to about $1 trillion in interest payments a year. And so Bessent came in with a stated aim of trying to lower interest rates. So lower interest rates, bring U.S. jobs back, bring better supply chains, and then geopolitical aims of trying to slow down or stop China's ascendancy. And the challenge with that is, it, as a result of having so many different aims, at times the policy is not coherent, and that incoherency is causing the market to have different seizures.
mm-hmm.
And the question is, like, is there some hidden plan that actually has sort of like some coherency behind it? And everybody, I know people who know Bessent. I know somebody who was with him last week, and they really are optimistic. They're super confident over there. I'm not as confident, but the point is it's really anybody's guess at this moment how this all plays out.
It's so interesting because that that's certainly not reflected in so much of the dialogue. And I'm willing to, I'm willing to, and I think we're all trying to stay neutral, right? And it's like, but I wonder what they're basing that optimism on. I mean, if they're executing it, there seems to be, I don't want to say dislocation, but there's a lot of concern that there is an exodus out of US assets. So I don't know if anyone's been on X today. And again, we know there's a lot of noise, there's a lot of, hyperbolic language all the time. And, that's how you get clicks. So I understand all that. But, some people are saying, there's a cartoon I just looked at that said, it's two guys in astronaut suits and saying, oh, it wasn't China, it was Europe that killed the bond market, that killed the US bond market because they're pulling assets out. Someone else is talking about, there's this sort of slow motion bank run on the US. Now, again, I'm not suggesting there is, there's a lot of, a lot of extremes, but there is a lot of concern about that. I would think that would be of concern for US officials, unless they feel super confident that something else is about to happen. I don't know. Like, how do you read that?
Yeah, I mean, it's funny because I don't want to be in a position of defending any administration, but I can't help but be a little bit anti-consensus at times. And so it's been 9 days since Liberation Day, right? 9 days is a blink of the eye. I think you really can't judge this policy for probably 6 months. It doesn't look good so far. I'm not, don't get me wrong, but I think it's, those types of capital flows can easily reverse, right? So
Yeah.
it's, so just if you look at the tally, the pros and cons, right? So, I mean, their stated aim was to lower interest rates. They're willing to take a recession. They want to bring back U.S. jobs. They want to reduce the deficit by having higher tariffs, and they want to weaken the dollar. So that, I mean, they're getting what they asked for,
Except the rates, right?
except for rates, and that I think, yeah, I mean, I think that it's too early to see the rate benefits. I mean, it seems like we're going to get a recession of some kind, and the way this could turn around, and I want to, again, I'm not trying to defend it. I want to just help people see how fast this could turn around. So if in the next week or two or some point in the short term, you see some sort of positive conversation between China and the United States, and they agree to lower the retaliatory tariffs to maybe 60%, which was originally Trump's aim, which is at 10% on the world and 60% on China. So we're going to lower it to 60% in the interim while we negotiate the deal. Okay.
Mm.
And then they'll negotiate. The negotiation probably takes 6 to 12 months. In the meantime, you end up with 10% tariffs on the world and 60% on China, which is not great, right? I'm not saying that's a great situation, but it's much closer to where the market thought Trump would be in terms of what he said he would do. And then, of course, that 60% tariff will be like Swiss cheese, because they'll exempt everybody and their mother who lobbies the administration, and sometimes for the good, and sometimes maybe frustratingly so. So I think over time, what we'll see is a lot of the things that upset the market will deteriorate, will come down. The tariffs and other kinds of disruptions will get sorted out, and then the cost will just be a market shock and a recession. And so then you say, okay, well, it's not optimistic for the market in the short term, especially the stock market. But if you look past that, you say, okay, 12 months from now, what's happening in the world? We're in a lower rates, lower growth environment, which is great for real estate, great for me. Probably not that great for the stock market for a while. But maybe we've ended up in a more stable world where we have negotiated kind of a détente, or a kind of a new status quo, because the previous status quo was clearly unstable. China was rising and the US was in denial about China's rise. And I have friends who were kind of in red pilled, right, who are new right, and they want to have this sort of proxy war they want to fight a trade war with China as a proxy of a hot war, because they don't want a hot war, but they want to show who's boss. And that's, I mean, so there's a lot going on here politically that is not good economically, but is motivating policies that unfortunately will have big negative effects in the short term.
So for real estate, you can, so I understand the rate side of things. Real estate does well in a recession because why?
Well, so real estate's a big sector. This is like saying stocks do well in a recession. Most stocks do badly, but some stocks do well, like consumer staples. So consumer staples do well in a recession, because when you're cutting your spending on restaurants, you're cutting your spending on travel, you're not cutting your spending on food, grocery stores, necessities. And so apartments, rental housing is a consumer staple, is an essential good. And so I think that apartments will end up doing pretty well relative to everything else. And that's the kind of asset we own. So we own, something like 20,000 residential units. And this shock is not like the last shock. It's made up of a lot. It's every recession is different. This one is going to have this massive consumer tax when cost of goods, that are imported go through the roof.
Yeah.
And so it's not like the inflation shock of 2022, which was a shock. The irony of the inflation shock is that majority of the inflation shock came through as increased wages. right? 70% of the economy is services. Services means people. People means wages. And so one person's inflation, another person's wage hike. And so it had a very positive effect for people who got the higher wages, and then obviously a negative effect when they had to pay more for the doctor or for service. This is nothing like that, right? I mean, all of the inflation shocks me on goods and imported goods. And so when you go to the store, you're going to see some things cost 20, 30, 40, 50% more, and there'll be no wage increase to compensate for it. And that's going to be like crushing, I think, on the majority of consumers. And that's going to really slow the economy, really slow the stock market. And people have to start making trade-offs. And so this is like, it took a long time to get here, 15 years. But for a long time, risk was not punished.
Yeah.
The more risk you took, the more you were rewarded. And finally now risk is going to have a cost. And that is like totally new for a generation of people. Anybody under the age of 40 had never seen this before. And that's, it sucks, but it's like, it's part of life, and everyone will get through it. And it's just like people are saying, I think there's some denial in the market still that this is just what's going to happen.
Right. So the tariffs helpful on the rate side, real estate a necessity. So in some ways sounds like a little bit buffered by recession. You've got to live someplace. What about the cost of building and materials? Does that offset some of the positives from lower rates? Because I've got to think that unless you believe there will ultimately be trade deals that will rectify that sooner rather than later.
But I do think there'll be some trade deals, but again, it's almost too late. By the time, trade deals will probably take 3, 6, maybe even 12 months to get done. So, but for real estate, the last couple months have been pretty bad for the industry. It's been a pretty dire recession in real estate, and almost no other sector, because it got hit by two problems. One is the higher rates, and then two, the 2022 boom caused a huge supply of new construction hit the market. So there was something like 1.1 million apartments were built because of the loose money period of 2022, the stimulus and the low rates, and that all got delivered last year and this year. And so the real estate market, and that's just not, everything got built, industrial and the sector after sector was huge, self-storage. And so we were living in kind of the worst of all worlds, which was oversupply. Ultimately, like supply in real estate means lower rents, less occupancy, and then higher rates. And so it was the worst of all worlds practically for real estate. And now you're going into a period where there'll be no new construction. There'll be no construction. Probably the rest of this decade, there'll be so little construction. It's be negligible because of the of all of the negatives we're talking about. And so again, I think residential will benefit from having no new supply, much lower rates, and the headwinds. There'll be some headwinds around the economy, but those headwinds are much less important to real estate than rates and competition. So another way to think about this is if you were a car dealer, if you own a car dealership, let's say you imported 1,000 cars last year you didn't sell, and then they increased tariffs 50%, which they did, increase tariffs on foreign imported cars, so far 50%. So now the cars you have in your lots, the price of those went up 50%. So your inventory is worth arguably 50% more because the tariffs increase the cost of any new import. So apartment units are the existing inventory in a market, right? So the existing inventory of any asset, the value of it just went up because the cost of supplying more into the market has just gone up, 10, 20, 30, maybe even 150%, depending on which source of imports you're talking about.
So what do you, one of the headlines, of course, today, and stocks markets were lower and it looked like it was going to be a tough day anyway, is President Trump coming out very publicly talking about Jay Powell, upset that he's not lowered rates, calling him a major loser, and a pretty public fight between them. Not a surprise, but what do you expect from the Federal Reserve? Do you think we're going to get lower rates? Is inflation a problem with that? And if we see this relationship spiral and somehow Powell get forced out, what do how will the markets take that?
Yeah, I mean, we've gone through 3 different eras now in the last 15 years. We went from lower for longer, and that was from 2008 to 2022. We were lower for longer. Then we went to higher for longer, and we were in 22 to 2025. It looked like we were going to have higher for longer, and now we're entering a new phase, which I'm calling higher for shorter, which is that the rates are going to be high in the short run in order to battle the spike from inflation. I don't know how long that is. It's unpredictable. Probably 4 to 9 months, 4 to 12 months. I mean, so it's a matter of months that they're going to have to keep rates higher. It's going to depend. It's path dependent, as they say. So that means that depends on where they end up on tariffs with China, where they end up with tariffs around the world, how much of a negative impact all these things have on consumer spending and unemployment, and the wealth effect was a negative returns in the stock market. So on balance, right, you can see that there's massive recessionary forces that will eventually pull down rates, but not in the short term. In the short term, we're going to have high rates and a bad economy, and that's pretty clear at this point. And even if Powell gets replaced by Kevin or whoever Trump wants to replace him with, that's only one vote on the Fed board. And so I think that, like, if the Fed feels like it's under attack, I can imagine that's ultimately like not how it plays out. Ultimately, I think that Bessent and cooler heads will prevail. I mean, it's a strange thing, but like the sort of inflammatory language coming from the president, mostly just people ignore. I mean, it can be outrageous. It can, and yet the country looks through it. And so I think country should look through it again. And the reality is that the Fed will probably stay relatively independent, and by the time they're cutting, which I'm imagining starts in the fall, but really gets going come next year. I mean, they're going to have to cut deep, because this is going to be a real shock to the ordinary worker. I mean, this is going to be a tough downturn.
So I mentioned the other area that you invest in is AI and technology. We're entering into earnings period. People super concerned about what's happening in the tech space. Do you see a big pullback in spend on AI? Does it feel like that's a bubble that's bursting, or again, with your longer time horizon, does it seem like that's overstated?
I mean, it's hard to say in the short run. It doesn't. I mean, nothing looks good in the short run. But in the longer run, I think AI is what pulls us out of the recession, and that AI will drive incredible productivity growth, and companies will still invest in it. And so, if you're invested in the top AI companies or things that are really, really close to AI, I think it's. I mean, this reminds me of 2008, right? 2008 was a terrible downturn, but tech ended up coming out and just driving the next bull run. So I'm super optimistic about it in the next 12 to 18 months. But in the next 6 months, it's hard for it to move the needle. And I think there's not only, I mean, it's interesting, right? You look at the Mag 7, and each of them, almost every one of them, has their own problems in addition to tariffs, right? I mean, like Facebook's looking at an anti-monopoly FTC action. Google just lost this case. Tesla's like struggling. I mean, it does seem like, I mean, that most of the Mag 7 will have a rough patch. But again, I mean, if you're an investor, the downturn we'll see, we saw on average over the last 7 recessions that average price decline is 30 to 40%. So that's an opportunity to invest. I mean, the U.S. is the idea that foreign investors are going to ban the U.S. on a permanent basis. It's just ludicrous. I mean, 10 out of the 12 major technologies that are changing the world originate in the United States, right? That's what Nouriel Roubini was saying last week. Like I'm seeing it with AI. AI is just insane. It's incredible. So long-term optimistic, short-term pessimistic, but that's problems and opportunity.
Yeah. Yeah, I think the sort of concern and the fog of uncertainty is making it really hard for people to keep their focus on the long term. And I think, and hey, everybody in the chat, I haven't said hi, but I've been reading all your comments. And I think that what I hear over and over again, Ben, is people expressing a concern that, that in the execution, the market kind of takes over and cascades, right? And we know that. And there, I think, is a lot of concern that people are going to turn away from the US or are going to end up feeling differently about the US in a way that they haven't before. And that the way policy's been handled, the uncertainty over it, makes the US, it's no longer that sort of the safe haven or the place where everyone wants to invest. And some of these policies will have the unintended consequence of, pushing Europe to do things that might make them a lot more attractive. And this isn't just on a short-term valuation. This is on a longer term, and that China is competing when it comes to tech. And, do we see realignment in a way that means that there's I'm not saying that some assets don't come back, but the best in class sort of persona of the US is tarnished. I think that is, if I'm paraphrasing everyone in the chat, what the worry is, that something breaks. Yes. And that the sort of confidence in the US has been fundamentally changed.
Well, okay. I mean, I gave like the most likely probability. There is definitely some tail risk here that the administration ends up being more ideological than practical. And this is probably what's scaring the market. Like I've been to China, done business in China. And so I called up some friends who are Chinese. I said, what's the sentiment like in China? And, the people I know are like, kind of like pretty elite in China, kind of elite tech players. And the tech industry was very negative on Xi Jinping because, he's been, crackdown Jack Ma. And a lot of people are, like the stories I heard were harrowing. It's really, it was scary to be in the tech industry in China the last 5 years. Nevertheless, because of DeepSeek and because of Trump, they are rallying behind Xi Jinping. They really have rallied behind him. They're ready to take the fight. They're ready to take the pain. And so in a world where the U.S. essentially just goes more ideological in terms of their approach to Europe and China and the rest of the world, then I think, there is possibility that that it gets much worse. I guess I just don't, yeah, it's hard to say. But it doesn't seem like that would be smart. I think that a long drawn out trade war with China where we basically keep tariffs at 150% and stop trade with China overnight. That does not help the United States in the stated aims of helping manufacturing. That will crush U.S. manufacturing. Doing that over 5 years. Okay. Now we have something to talk about. So it's just that, just the strong rhetoric. I did a podcast. I have a podcast. I don't know if you know this, Maggie. So I did a podcast with a couple people in the last couple weeks. If you look at Trump's previous negotiations, he did a long negotiation with China in 2019 called the Phase 1 Agreement. And he also tore up NAFTA and renegotiated it into USMCA, US, Mexico, Canada agreement. And in both times, the rhetoric was outrageous, just beyond the pale of what any person should ever say. The threats and the tariffs that were threatened and then sometimes put on were just, not justified. And we got to a place in both cases that was pretty reasonable. I mean, like night and day between how bad the threats were and how normal the agreements that were signed. Now, do you say, okay, well, that was last administration, there are people around him that would provide moderating influence. The market's doing its job. The market's forcing him to moderate. So good. Everybody should just completely lose their mind, because the more they lose their mind, the more it prevents bad things from happening.
That's really interesting. It's delivering a message, and we've seen how effective that can be in the past. I don't know if anybody remembers Congress voting down relief in 2008 when the market was seizing up, and boy, that they got ran right back on the floor and took that vote again, because the literally the bottom fell out and the market was wrecked. So the market, when it wants to, can. I think that's right. I think that that's what people are looking at in the bond market and saying, wait, this is not. Like, they're letting you know that they're not happy with how things are executed. You're in DC, by the way, so I know you're having a ton of conversations. I mean, you're living in the middle of this. What's the signal in terms of whether cooler heads are prevailing? What are people looking at to say, like, oh, okay, because we saw it. It seems like Bessent, so many hopes are pinned on Scott Bessent having a major say and a voice, because he understands global markets.
Yeah. The people I know who are inside different parts of this administration and Doge, what's happening on the ground and what's happening in the sort of media is there's just no relationship. There's so much fake news and drama. And so, I think I had a friend who worked in Clinton administration. So this is now a long time ago. And she said to me, God, was that 20 years ago? Jesus. So anyway, so she said to me, working in the White House is like going duck hunting, but you're the duck. And so everybody's shooting at you.
What does that mean?
It means everybody's shooting at you. Everybody, you think you get power, but actually it's actually just like everybody's shooting you all the time. So, I feel like the chance that this goes really bad is unlikely. And that's this is why buying in the downturn is so difficult, because the uncertainty and the fear and the panic and the media just gets away from anything that's likely. And so, but I don't think we're there yet. I think we got, at least a couple more months of pain and confusion. And, but I remember before when the pandemic was hitting, and I was walking around the office being like, oh, this reminds me of 9/11. And people were too young to remember 9/11. 9/11 was really scary, and the country worked through it. Everybody alive practically now has been through COVID. This is, you look back and it works itself out.
Yeah. I think the difference is it feels different because of the nature of the Trump administration, right? Like, I think that's what feels different.
Well, it feels
there's a lot of market veterans who are very worried.
Yeah.
These are not people who are, that's I think what people are kind of paying attention to. And so I think it's because of there's some concern that there used to be a set of rules the politicians played by. I use rules loosely because, these are politicians we're talking about, and that they're just, the people are just not sure now, like if any of that applies. So it seems hard to handicap.
Yeah. And it probably escalates more before it actually comes together and into a détente. It seems likely that some of the things in Steve Moran's plan, his roadmap that he published 4 or 5 months ago, still haven't actually been implemented. And so a couple of them that they talked about in the plan that I think would, certainly make everything seem worse in the short run. They talk about adding a withholding tax to all foreign U.S. investors and all foreign investors in U.S. Treasuries. So if you are China, Japan, UK, they're going to start doing withholding tax. So tax you for holding U.S. assets. if that ended up in the budget that's going through Congress right now, people would go insane, right? That probably doesn't happen. The other thing that I think will happen is that they plan in the document, they talk about taking the gold in Fort Knox, U.S. gold, revaluing it. It would be revalued close to $1 trillion, and then putting that into a sovereign wealth fund or the exchange stabilization fund, or it's called emergency fund. And they could do one of two things with it. They could sell dollars, right, and maybe attack the yuan, attack the renminbi, or they could stop issuing new treasuries and use it to fund the government and pull essentially a lot of the current supply out of the market. So if they do revalue gold, and in the tweet last night from the president where he said, "He who holds the gold, the golden rule, he who has the gold makes the rules." Like I actually took that as a tongue-in-cheek reference to what's coming, which is this sort of revaluing gold. So there's a lot more. There's a lot more to come, and that just managing through this type of uncertainty and this type of chaos is just like, this is really when businesses and fortunes are made. It's hard to actually have great success in finance when things are quiet. It's really when things are chaotic, and you have to, like Warren Buffett, my God, $325 billion of cash on the sidelines. Once again, he did it.
I know it's kind of astonishing. Are you across? We had some people commenting, and I don't know if this is something that you look at because you're in certain. We just talked about a lot of multifamily in terms of real estate, but some people asking about the Miami situation. Are you aware of that? Someone asked about the. Sorry, I lost yours, Christopher. About the I don't know, was it a bankruptcy, folks, or something? Somebody's under pressure. They have high-end real estate in Miami. How weak is the super high-end Miami condo construction market, like Bentley and Cipriani? Can prices drop 40% before they unload all the inventory?
Yeah, well, we're not in the Miami market. Miami market is a derivative of South American, commerce. So it is like a globalization trade on foreign investors in the United States. So the extent that it's that got disrupted by what's happened recently, and then it's very negative for Miami. But this is like my whole philosophy on real estate is you try to play for the singles, you don't go for the home runs. And Miami, New York, San Francisco, they're markets that just like were very high highs and low lows, and so we are not investors in those markets.
So last question for you is, in this, it sounds like we're in for certainly a lot more volatility, maybe a lot more pain. How do you navigate that? You obviously you're obviously going to take a punt and try to, like you said, fortunes are made when there is all this kind of opportunity. But how do you do that? Are you being really defensive right now and looking for those opportunities? Which, by the way, I'll remind everyone, you did on the Silicon Bank Valley, and that's how you got into AI and AI investing, because you saw an opportunity and had the dry powder to take advantage of that. So you've got a great track record with that. How are you kind of positioning to make the most of what is going to be super hard, but also maybe some fantastic opportunities?
Yeah. A shortcut is just wait for Buffett to move, right? Buffett will be
I don't want to say what everybody's thinking though, but like, is Buffett going to be able to make that decision? Is he still here? The guy's right. He's very advanced.
Well, even Berkshire Hathaway, they made the decision. They're at $325 billion. That was the hard
so the company,
part. The hard part is going on to the sidelines when everybody's saying it's the top, it's great, you should keep going. Like, getting out of the market much harder than getting into the market. And so, and he normally comes in first as a lender and then later as a buyer. And so it seems to me that it's way too early to try into the market. It's still time to be defensive, even more defensive. And it's like, what is it? Buy the dip, sell the rip. Like, yeah. So it seems like we're probably in the second inning of this. Like, we're really, really early, and it's just beginning. There's so much more pain to come. And just knowing that's how it happens. It's just how, like, whatever, like any kind of athletics, like there's periods of high stress. And yeah, I mean, for goodness, this is not as bad as the pandemic. It really isn't.
Mm.
It's it was created by people, and it can be solved by people, right? Which is the Trump administration. And ultimately, I mean, this is the far end of this, is that if for whatever reason it gets ideological, 6 months from now, probably Congress passes and pulls the tariffs. So that's, I mean, if the tariffs are gone, are not negotiated by the end of this year, I think you should expect to see that the Congress to start to act congressional again.
Interesting. We started this before. I don't think we were on. I think we were talking before we started, and I was talking to Ben about living in DC and being the center of the universe. And you said that's never a good thing. But it seems like that is where we are for the foreseeable future.
No, it's so funny. Like nothing good comes out of DC, but when all bad things end up back here. So, yeah, but I mean, it's everything, nothing new under the sun. So it's like 2008, it's like 2001, it's like 9/11, it's like COVID. And each one of those things, people who either were there or read about it, right? It's just like, it just happens. And it's like, hopefully you weren't over levered coming into this. And even if you were, I have friends who went bankrupt in 2008 and they're doing great now. They learned a lot. I mean, it's part of the process.
Yeah. Keep cooler heads prevail and keep your eye on the long-term opportunity. Ben, we always love when you come on. Thank you so much for being with us. We appreciate it.
Yeah, thanks for having me.
Thanks, everybody, for the great comments. We are going to have quite a week, I think. So we will see you again. In the meantime, take care and good luck out there.